Hey everyone, welcome back to Corporate Decoder, the place where we translate confusing corporate speak into plain English, or in this case, unpack a massive earnings report that's got some interesting moves. SPX Technologies, the company behind all sorts of heating, ventilation and cooling systems and detection measurement tools, just dropped their latest quarterly report. And folks, there's a lot to unpack here. They've been busy buying companies and it shows in the numbers. Let's dive in. First up, revenues for just 3 months ending June 2025, they pulled in $552.4 million. Now, that's up a pretty significant 10.2% from the same time last year. They credit this boost to new companies they've acquired like KTS and Sigma and Omega that are adding to their sales. It's not just about buying though, they're also seeing organic growth, meaning their existing businesses are selling more too. This is a good sign that their core operations are healthy. Looking at the first 6 months of 2025, revenues are even higher, hitting $1.035 billion, up 7.1% from the first half of 2024. Again, acquisitions like Ingenia played a big part here, along with KTS, but the HVAC side also saw some good organic growth, while their detection and measurement business saw a slight dip organically. Now, let's talk about gross profit actually getting better. For the 3 months that ended in June 2025, it jumped 14% to $228.9 million. And as a percentage of their sales, it climbed from 40.1% to 41.4%. This tells us they're not just selling more, but they're also making more on each sale. This is a big deal. For the 6-month period, it's similar, a 10.7% increase in gross profit, with margins also improving. This efficiency gain is likely coming from better operations and maybe even the new companies fitting in nicely. However, not all costs are going down. Selling, general and administrative expenses, or SG&A, also went up. For the 3-month period, it rose 15.8% to $117.2 million. This is largely because of higher costs related to their recent acquisitions like KTS and Sigma and Omega. They're also spending more on their people due to pay raises and new hires. For the 6-month period, SG&A is up too by 11.1%. This is an area to watch as these new businesses integrate. And speaking of acquisitions, a big jump here in intangible amortization. This is the accounting cost of recognizing the value of things like patents and customer lists that come with new companies. It went up a whopping 46.4% for the 3-month period and 46-month period. This is because of the new intangible assets from KTS and Sigma and Omega adding to their costs. So what's the bottom line for their main business in continuing operations? Well, income before taxes for the 3 months ended June 2025 was $69.9 million. That's a solid 15.7% increase from last year. And for the 6 months, it's $158 million, up 14.6%. Even with higher expenses, the sales and profit gains are pushing them forward. Taxes played a role too. For the 3 months, they paid $17.4 million, up about 14.5%. For the 6 months, it was $23.6 million, a bigger jump of 38%. This higher tax bill is partly because of special items like the tax benefits they got in the previous year from employee stock programs. After all that, income from continuing operations for the 3 months ended June 2025 came in at $52.5 million. That's a healthy 16.2% jump over last year. For the 6 months, it's $104.2 million, up 10.4%. These are good numbers showing growth despite the increased cost from buying and integrating new companies. Let's look at some key deals. The acquisition of KTS for $342.4 million in January 2025 was a big move. This company works in digital networking, mainly for defense. It's now part of their detection and measurement segment. Then in April 2025, they picked up Sigma and Omega for $143.6 million. These guys specialize in heating and cooling equipment, and they're now bolstering their HVAC segment. These acquisitions are clearly shifting the company's profile. And you see the impact of these deals in the goodwill section. Goodwill on their balance sheet jumped from $834.5 million at the end of 2025. This is the premium they paid over the actual value of the assets they bought, essentially the value they see in the future potential of these companies. Their intangible assets also grew significantly. Customer relationships, technology, and trademarks from these new companies are adding hundreds of millions to their balance sheet. It's clear they're investing heavily in future growth. Now let's check the cash flow. For the first 6 months of 2025, operating activities brought in $33 million. This is lower than the $69.4 million they generated in operating cash in the same period last year. A big reason for this drop is that they put $46.5 million into an escrow account as part of the KTS deal for employee retention. So while income looks up, cash flow is a bit tighter this period. Due to these acquisition-related cash movements, investing activities show where the money's going. They used a staggering $457.8 million in the first 6 months of 2025. Most of this $47.7 million was spent acquiring KTS and Sigma & Omega. That's a huge chunk of change dedicated to expanding their business. Financing activities show how they funded all this. They borrowed a lot of money. For the 6-month period, net borrowings under their credit facilities and other arrangements totaled over $395 million. It's clear they're leveraging their debt capacity to finance these strategic moves. Looking at their segments, the HVAC business is doing well. Revenues grew 5.7% in the 3 months ending June 2025, reaching $376.7 million. Segment income also jumped 14.5%. This is thanks to the Sigma and Omega deal and steady organic growth, driven by strong sales of heating and cooling products. The detection and measurement segment had a more mixed story. Revenues soared 21.3% in the 3 months ending June 2025 to $17.7 million. This is largely because of the KTS acquisition. However, their segment income only increased 18%, with margins actually shrinking slightly. This suggests that while they're selling more thanks to KTS, the profitability per dollar of sale isn't as strong as it was before. The backlog for this segment also looks impressive. It grew from $2,054 million a year ago to $365.4 million by June 2025. That's a huge increase, showing strong future demand for their products. Corporate expenses also ticked up as expected with the acquisitions. They spent 2.4% of revenues on corporate functions, which is pretty standard. However, the increases are tied directly to integration costs from their new businesses. Long-term incentive compensation, which is basically their stock and option awards to employees and executives, also went up slightly. This reflects changes in their long-term incentive plans, potentially making them more rewarding, which could motivate their team, but also adds to expenses. Let's talk about their debt. After all these deals, their total debt as of June 2025 stands at $1.019 billion. That's a big number. While they have healthy cash flow, the amount of debt they're carrying is something to keep an eye on. They do have good availability on their credit lines though, which is a positive. SPX Technologies is clearly in a growth and consolidation phase, buying up companies to expand its reach. The acquisitions of KTS and Sigma and Omega are significant moves that should drive future revenue. The fact that their gross profit margins are improving even with higher SG&A costs is a strong sign of operational efficiency. However, the increased debt level and the slight margin pressure in their detection and measurement segment due to acquisitions are areas that need careful watching. They need to ensure these new businesses integrate smoothly and contribute to profitability as expected. The growing backlogs well for future revenue, but execution will be key. They're navigating a dynamic market with economic uncertainties and geopolitical issues, so adaptability will be crucial. Overall, SPX seems to be strategically repositioning itself for growth. The financial performance in this report shows considerable progress on that front, driven by smart acquisitions and solid execution in their core businesses. But the financial discipline to manage the increased debt and ensure profitability from these new ventures will be essential in the coming quarters. What's your opinion on SPX's latest moves? Are these acquisitions going to pay off, or is the debt too much? Let me know in the comments below. If you found this breakdown helpful, give this video a like and subscribe for more deep dives into company filings, and don't forget to join our Discord community linked in the description for more real-time discussions and insights. Thanks for watching, and I'll see you in the next one.